know that ETFs are particularly in demand for very liquid, efficient markets, but do you think that ETFs can add value in asset classes like where the value of research or return dispersions are usually high, like fixed income? Fixed income investors are facing rising interest rates, flattening of the yield curve, maybe comeback of inflation. So how can fixed income ETFs help investors to address this issue? Bernard?
There are so many various dimensions on how you can use fixed income ETFs. I mean, it starts with a core allocation. You know, for example, the global aggregate ETF as the really largest index available, which gives investors a very efficient tool of investing into an underlying which is very large. Then I mentioned previously already the so-called duration buckets. So when you have a target duration in your portfolio, but you want to temporarily go lower or higher, you can use those duration ETFs quite efficiently, and it comes back to the tradability of ETFs because you can use them for short-term allocations or for technical trades. And then again, I think overall we see a trend we see an increasing trend towards fixed income. I think this year the flows were mainly in equities in Europe, 75%, which had to do with the market. But if you look at, for example, a year like the first 6 months of 2016, it was mainly fixed income ETFs that have been bought. But as you mentioned, liquidity in your question, it always depends on the underlying. You know, I wouldn't say a very illiquid underlying is perfectly prone of being an underlying for an ETF, because ETFs are liquid instruments.
For me, it's it's a useful tool to mitigate risk, mainly, for example, in high yield space. The liquidity in the overall markets, in the bond market, is a real issue in the world. Roughly, the FICC traders, the number of fixed income just is dropping dramatically now. Banks, due to regulations, are less and less books for market making. And the liquidity is a real concern on the bonds market. When you try to sell 1 million on the high yield bonds, it's just a nightmare. If I ask a market maker in ETFs, I can have a price for 50 or 100 millions in the high yield bond ETFs, like that. And also, now we can pilot an asset allocation very smartly. You can sometimes play with some ETF to play the flattening on the steepening of the curve. Some strategy like that is quite useful.
Also for if you talk about retail investors or mass affluent investors, I mean, how else do you want to get them exposure on bonds unless you just buy them 1 or 2 bonds? But I mean, you want to have them also be diversified in their fixed income.
If we talk about high yield, it's true that it's interesting to see that ETF has been really bulletproof during the last financial crisis and more liquidity provider than the opposite. So it's maybe less a concern, but our concern is more on the tracking error and the tracking difference in terms of performances. And it's less clear that these kind of ETF are able to challenge the top quartile fund manager, especially in high yield or emerging debt. So it's less clear than for equity, but again, it's a plus, definitely.
But there is a massive room to improve the granularity. In countries, for example, it's very difficult to buy an ETF on a single country in bonds. You have states, of course, in Europe. You have Italy on Germany, but there is nothing in French to be exposed on the French bonds market, or govies, I should say. You have to buy a broad one with 40% of the French paper inside, but you cannot buy directly a single country.
Usually, what we do, we only try to launch products once we are convinced that the combination of client demand, in the medium term, doesn't need to be immediately, client demand in the medium term and liquidity is there, plus also the relevance.
On the private investor side, quite frankly, no, we won't use ETFs.
Right.
And it's really...
so you do not use fixed income ETFs at all?
We suggest active management, whether it's through a third-party mutual fund or an in-house discretionary fixed income mandates, depending on the client. Obviously, our discretionary managers would potentially use ETFs. Right. But we really believe there's a lot. What we're looking at is unconstrained fixed income and the client. And right now, timing is an important factor because the markets, on the fixed income side, markets are moving much faster than our clients can move. That being said, where we also have raised a lot of assets is on floating rates. So we have looked at ETFs in the floating rate note space, or the short maturity global ag type of ETFs.